Listen, sorry to interrupt, but it really is important for us. If you can just hit the like and subscribe button, that allows us to bring you the very best financial intelligence and the best guests on the planet. Anyway, appreciate it. Like and subscribe.
Scott, welcome to Real Vision.
Thanks for having me, Ash.
I have to tell you, we're so excited to have you with us today. I got a message from our CEO and co-founder, Raoul Pal, this morning saying, "Oh my God, how did you manage to book Scott? He is a true legend in the hedge fund space," words I know that he doesn't use lightly. This conversation, we're just excited to have it with you. We're going to talk about markets, of course, everything that's happening on the macro front. But first, we also want to talk about your career and all the wisdom you've gained over your decades as an investor. You've had a storied career in the space. Tell us a little bit about how you got started, what first interested you in markets.
Sure. So I don't know if it's wisdom. I think a lot of it is probably scars and some unfortunate muscle memory. I tell my team we try to make this not to make the same mistakes, but we will always make new mistakes. So I was fortunate enough to identify and get into the hedge fund business really in its infancy. I got to Yale. I was very interested in both writing and computer science. And I did a summer internship with George Soros' original partner, Jim Rogers. And it occurred to me that investing, especially in this nascent hedge fund fashion, for me, was a wonderful combination of you created a narrative, and then could you apply some kind of quantitative techniques to it to turn it into an investment. So I began with that summer internship with Jim Rogers, and they had a few training courses in between then, and walked in the door at Soros Fund Management in 1988 as a sub-advisor. And then in 1991, Stan Druckenmiller asked me to join the team. And I think what is interesting, in macro, there are a lot of different models. There's if you think about kind of the lineage, there is the Caxton Commodities Corp model. There is a lot of fixed income RV models, Brevin Howard, Chris Rokos, which obviously turned into much more directional. And then there's what I would call the Soros Duquesne model, which all of us actually began as equity research people. And we have a saying, the micro drives the macro. And we never thought we were better at constructing what are non-farm payrolls going to be. Is core PCE going to round up, round down? We spoke to a lot of companies in the real economy, observed what was going on, and then constructed a mental model of the macro environment. And I think for all of us, it then turned into something bigger. And I could tell you is if I look back at my career, other than this year so far, I've made the most money in foreign exchange, and followed by equities, followed by fixed income, followed by commodities. And I would say a lot of my success in foreign exchange has been thinking like a corporate. What would make a cash-rich corporation move money in and out of a country, across national boundaries? What would make you not want to hold a currency? What would make you be inclined to not repatriate earnings? So, I was very fortunate. I had some great mentors. I would say Stan Druckenmiller, maybe the greatest money manager of all time, never a down year, and incredible human being, wonderful thinker, amazing trader, and for one of the richest people in the world is still at his desk, loves the every morning by 6, loves the game, is I can't remember how old he is now, but still as engaged as ever. So, I think that I was very fortunate not only to have people who gave me great training, but who had a great love of the game. It's a Michael Jordan, idea. I think Michael Jordan might have been the first NBA player to actually have a clause in his contract that he could go and play pickup basketball because he loved basketball so much. And I think that there's a group of us who, I think we all think we would maybe intellectually, emotionally, maybe even physically atrophy if we weren't somehow engaged in the markets every day.
Ever wanted to explore the world of online trading but haven't dared try? The futures market is more active now than ever, and Plus 500 Futures is the perfect place to start. Plus 500 gives you access to a wide range of instruments: S&P 500, NASDAQ, Bitcoin, gas, and much more. Explore equity indices, energy, metals, forex, crypto, and beyond. With a simple and intuitive platform, you can trade from anywhere, right from your phone. Deposit with a minimum of $100 and experience the fast, accessible futures trading you've been waiting for. See a trading opportunity? You'll be able to trade it in just 2 clicks once your account is open. Not sure if you're ready? Not a problem. Plus 500 gives you an unlimited risk-free demo account with charts and analytics tools for you to practice on. With over 20 years of experience, Plus 500 is your gateway to the markets. Visit us.plus500.com to learn more. Trading in futures involves the risk of loss and is not suitable for everyone. Not all applicants will qualify. Plus 500, it's trading with a plus.
Well, Scott, you were present at the creation, so to speak, of this industry. Some of the names you mentioned, absolute legends in the space. Stan Druckenmiller has been on Real Vision, so has Jim Rogers many times. Uh, you mentioned the idea of the models that you use. Let's unpack a little bit about that. Talk about those 3 models that you mentioned, how you came to land on the one that you use, and how you apply it in your investing framework.
Sure. So, I have a saying: we study history, we observe the present, and we try to imagine the future. So, I actually taught economic history and market structure at Yale, and one of my sayings is never say never, and never say always. And that's been very, very helpful in some of the bigger wins in my career and keeping me out of trouble. Uh, but the way we go about our business is we observe what's going on, and we're looking for anomalies or systems that are either accelerating or could break down. And so, I would say every Monday, I come in and I have a lot of theories. I am very loath to say, and I dislike people in the social sciences who try to compare social sciences to hard sciences, because I think that's like the certainty is where we all get in a lot of trouble. And but I do think that there is a process one can follow. So we have a theory, then can we gather enough data and prove it empirically? And then how do we want to frame that? Is what's our theory of the case? Is our framing correctly? Are we looking at this the right way? And then, so step 1 is theory. Step 2, can we prove it and come up with framing? And then step 3 is we go back to the street. Unlike most people, we don't begin our process with something from the city, from Wall Street, uh, but we do use it as the final check. So, we may have this elaborate theory, and it may turn out when we go to the street, everybody else is in agreement with us. The positioning is high. We may think we split an atom, and somebody's been thinking of this for 3 or 6 months. It may show, in option skew that it's already priced in, and we're very happy to put our work up on the shelf and come back to it. So, I would say a lot of what we do is we compile the research and then we don't trade. And Ash, to your question, I would say that a lot of this process, it results in being patient, which I'm 61 now, and I think my job with my team and even myself is to still be Dr. No. That idea is not unimportant, but it's not undiscovered, or it's not really a big idea. Like what are we playing for here? What do we know that others don't know? What is our? We try to have an inferential edge, because in the market today, you can't really get a data edge. You probably don't want an information edge, but in terms of your framing, how are you thinking about it maybe in a different way than everyone else?
Hi, Raoul here. Listen, I think we've got until 2030 before the economic singularity arrives. Now, it might not be the exact date, but it's around then. So we have about 6 years to figure out how to unfuck our future. I've put together a report to help you called Prepare for 2030. It's going to help you take the first steps in that journey to make sure you're secure past 2030. So just click on the link below and start your journey now.
Scott, talking about thinking about things in a different way, and the legendary background that you have, one of the trades that often comes up in Real Vision is one of the great legendary hedge fund trades of all time, of course, is the Black Wednesday 1992 sterling crisis that you were involved with, that Stan Druckenmiller was involved with at Soros. Talk a little bit about that story, since it's one that is just so ingrained in the annals of hedge fund history.
Yeah. So, again, it I think that we had a framing advantage on this. Is we had the belief, and we were able to. My small contribution was backing it up with data. Stan Druckenmiller correctly analyzed the risk reward in terms of the ERM at that point was a series of corridors that currencies had to stay in. And the governments, central banks, as always, tend to think in very linear fashions. So, if there was a 2.5% corridor on either side of the British pound versus the Deutschmark, they could, if the British pound was very weak, it would go to the top of the corridor, up 2.5%. If it was very strong, go to the top of the corridor and up 2.5%. If it was very weak, 2.5% below the central level. So there's 5% range there. And what Stan correctly identified was we could push the Bank of England up against the bottom of the band, and they had to buy an unlimited amount of sterling. My small contribution, and I think this goes back to framing, is we believed that the market didn't understand how fragile the British economy was, or how geared the British economy was to short-term rates. So Margaret Thatcher had come in the 80s and made the UK a home-owning society. UK mortgages, unlike long-term US mortgages, floated with the overnight rate. So Bank of England raised rates on Wednesday. On Friday, you, Mr. and Mrs. Homeowner, got a notice that your mortgage had gone up. So we were of the belief that as the Bank of England can raise rate to stabilize the currency, they were actually destroying the British housing market, which was the most important component of the British economy. And that proved true. And I can't remember which day it was, leading up until what we like to call White Wednesday and the emancipation of the British economy, the British people, that there was a point where the UK government raised rates, or the Bank of England and the Chancellor raised rates, and the pound went down. And I think that's when the UK to stay in. And like if we were to go back, you just ended up with structure was full at the beginning. A lot of times, these flawed structures always take longer to break down than you think. And there's just this at the end where the UK government wisely stopped supporting the pound. I mean, look, it was a loss for the UK Treasury. It was a loss for the Bank of England, but it could have been much bigger if they had continued trying to support the failed policy.
Stan Druckenmiller's talked about this with Kirill Sokolov on Real Vision. That's on YouTube if you guys would like to go check it out. But boy, I think two things about that, Scott, that really are true milestones. The first is this view, as you described there, that markets have the power to impact sovereigns in a way that sovereigns can no longer control, that large industrialized nations like the United Kingdom simply, they just get away from it. They just can't hold on to the policy that they want. And second, perhaps a truly enormous moment in finance where a hedge fund had the ability to apply these real world market forces in a way that contradicted the narrative of the Bank of England, indeed of the British government. Just an astonishing moment for people in the hedge fund space.
Yeah, well, look, I think it was really just a power acceleration. It was never going to work. It just brought forward the moment. And Ash, obviously, it wasn't a single hedge fund. It was a wave of market forces. It was a wave of banks piling on. And the other thing too is it was a wave of corporates trying to get out. Because at the same time, Italy devalued a few months later. They did not leave the ERM because
it's the exchange rate mechanism that was in place.
Sorry, yes.
The band
So they didn't leave the bands. They recalibrated within the bands because they had probably come in at the wrong, or they had obviously come in at the wrong rate. So again, you were trying to create this unified currency where capital is very mobile, but economies are structured very differently. Right? And there was also, in the US, if I think back to the 80s, there's the energy bust. There was a record number of U-Hauls that went from Texas to Ohio. Right? And, kind of vice versa right now. So there was complete mobility of labor. There was a central government that could smooth over, and this didn't exist. So back to systems that accelerate, systems that break down. It was a flawed system, and then as the economies diverged, it became more apparent.
Scott, I know you say you played a small role, but this was a huge bet for the firm at the time. And everything that I know of Mr. Druckenmiller, he did not make that move without the extensive data that you provided.
Yeah, but again, it was the asymmetry of the risk reward. If we look back over some of the great trades or investments of all time, it's really the asymmetric nature. If we go back to John Paulson's famous subprime trade, is he had structured it with a CDS portfolio. So investors knew, I can't remember what the negative carry was. I'm going to say it's 5%. It was 5% per annum. It was a 5-year fund. You could lose 25%. And that if the housing market cracked, which it did, then you could make 250 350%. So, Ash, I think what you're getting at is, how do you identify asymmetries? And they don't come along often, and you've got to have an open mind. That goes back to never say never and never say always. Like, if you go back, I remember during the housing trade, or the leading into the GFC, there was a mantra in the U.S. The U.S. housing market has never had a down national year. California's been down, Arizona's been down, New York, but in general, it had never happened before. Well, we had never had a national banking system. We had never had a CDO machine being spun out like Wall Street had before. We had never had such a high level of subprime loans. So, it's always very interesting to me. Like, that's kind of red meat for us when someone said, "Oh, this could never happen. This has never happened. This will never happen," or to say, "Well, it's always okay." We could talk a little about the developed market debt. A little later, maybe we'll talk about developed market debt. Well, it's always okay. The U.S.'s reserve currency, nothing can go wrong. Or China has complete control of their economy. There's no way that they could have an economic meltdown.
This notion of asymmetry, the idea that you have disproportionate reward per unit of risk is, I think, a fascinating one, and one that I'd love to explore in the context of what you're doing right now at your work at Key Square Group, to talk a little bit about the current macro picture, what you see. You touched on some of those points with China, with the United States, with debt levels for sovereigns in aggregate around the world. Let's just talk about it. As you see the picture right now, what are some of those assumptions that people are saying are always baked in, things that are never going to happen, that you see those potential asymmetric reward opportunities on?
Yeah. And actually, if it's all right, I'll just go back to 2016, 2017, because a lot of the asymmetry, sometimes the institutions can set you up for asymmetry, as the Bank of England did, as the Bundesbank did, as with the Abenomics, the Bank of Japan, and the Prime Minister's office did. But other times it becomes behavioral. And like, if I think back to 2016, the world was shocked that Brexit happened. And so that happened. There was a kind of a week-long meltdown in markets and bond yields, and somehow the UK not being the EU was going to destroy the financial markets. So on Brexit night, I was at a big macro conference in Villa d'Este with everyone. You've probably interviewed a lot of the people, and the next morning the room was in a complete panic, and there were only three of us who thought everything would be okay. And one, myself, Sir Richard Dearlove, who was former head of MI6, and Ayaan Hirsi Ali, Neil Ferguson's wife, who was seeing, so many crazy things happen in her life and in her world, that like I think she thought, so what compared to her life story. And then a week, 2 weeks later, things settled down and the world didn't end. Fast forward to November of 16, and I wasn't sure Donald Trump was going to win, but I thought he could win. And I thought the market wasn't pricing that in. Then it was announced he had won, and the market crashed that night. And the S&Ps went limit down, and I was sitting there thinking, look, this could be the most pro-business president for 100 years. I'm not sure why this is happening. So we were able to accumulate a very large position in that. Move forward to the French elections in April, May of 2017, and this is where it becomes behavioral, is if you're a fund manager, you got Brexit wrong, you got Trump wrong, you're not taking any chances that Marine Le Pen is going to be the president of the Republic of France. And the French, one of the things the French are very good at is polling. So there was very robust polling that showed that Emmanuel Macron was going to win against Marine Le Pen. The French have a blackout period. I can't remember, it's 1-2 weeks before the election. So you went into this blackout period that just turned into like the little shop of horrors for everybody's imagination that, oh, the polls are wrong. Just like with Trump, there are reluctant Le Pen voters who are lying to the pollsters. So I remember like it was yesterday, I think the French vote on Sunday, the Friday before the election, the euro was at 105 versus the dollar, the 90 puts. So that the euro was going to move 15 big figures in a month had never been so big. Like the skew was out of the park. The 110, 112 and a half, 115 calls nobody wanted except for us. And, again, I couldn't have 99% confidence that Macron was going to win, but the market was paying me to take the risk. Then even on the night when he won, the euro only went from 105 to 107 and a half, 108. So we could buy a lot more euros. So, a lot of it is behavioral. So, you ask a good question now is I think we're at a very interesting point now in macro because the opportunity set is very rich and a portion of it is government policy, but a big portion is how are people interpreting the behavior around the government policies. There is a substantial decoupling going on between the US and China. I think that to a lot of people, it's unimaginable. And, we don't know where this is going. I would say I am less worried about a kinetic war than most people are a kinetic war over Taiwan, but I am much more worried about the global economy, the U.S. economy, that the U.S. economy or the U.S. government is dependent on external financing. So, you try to imagine a state of the world 1 year, 2 years, 3 years out on, where are we with the U.S. and China? Is, would China have done a big devaluation? Have they flooded the market? As we're seeing, they've gone from wanting to be the sweatshop of the world to the machine tool shop of the world. And now they are exporting, they moved up the value chain. And if they're moving up the value chain for these products, what's the business model for Korea at that point if there's a big overlap with a giant manufacturer that's exporting deflation? What's the business model for Germany if that happens? So, I think with China, I think the U.S.-China, it just gets very, very difficult for people to imagine how ugly this could get in the decoupling. And I think it would probably accelerate under Trump. I don't have any particular information. We could see what some of his advisors are saying, but you're also seeing it under Biden. And I think the Biden administration has been firmer on a lot of the export bans than I would have expected. I think that they are quite tentative right now. Blinken was in China. Secretary of State Blinken was in China this week. He put down a red line for the Chinese government over its support of Ukraine. The Chinese told him to get lost. So my sense is that the U.S. will not enforce the red line before the election, but that after the election, anything's possible in terms of what kind of sanctions the Biden administration might put on China. So, there's really, if we think about going into November 5th, this thing could really accelerate.
What are some of the gauges that you're looking at on your screen to understand those stresses in China, to understand this potential decoupling? Because this is a significant, not only global financial, but geopolitical story that you're looking at.
Yeah, so we're looking at all the Chinese trade balances, their trade with the developed world versus what's now called the global South. What is being exported, repackaged, and sent. What are the sanctioning that the U.S. continues to do on technology? What is happening with the Chinese central bank? Interest rates in China had been quite low. The bond market reflected the deflation that's going on. Now it looks like they're trying to steepen the yield curve for some reason. So we're looking at internal stress, external indicators, and then fund flows. And and again, if I go back and I think like a corporate, one thing Trump administration has done or did, the Biden administration has done. If you are a U.S. corporate or you are a G20 corporate, would you ever build a factory in China now? So there can be portfolio inflows and outflows. Bridgewater came out and said they're bullish on Chinese equities, and sure, Chinese equities could bounce, but in terms of foreign direct investment, what would make a long-term investor put money in China right now? If you think, if you think about the Chinese currency, it really exists in two different equilibria. One is it may actually be cheap. They've done a big internal devaluation. They've pushed down the cost of labor. They've deflated some of the assets. They are experiencing disinflation that's turned into deflation. So the currency could be cheap on a normal, if you're looking at normal equilibrium, but what is the equilibrium for not getting your money back? And clearly the Chinese, the signals that Xi Jinping is sending, and the signals that the U.S. is encouraging people to think about is, is there a 5, 10, 20% chance that if you have RMB, that your assets will be frozen, or that you have the equivalent in Chinese equities of a day like you had in Russian equities when everything went to zero?
Those are some truly material tail risk. And it's interesting to hear you talk about FDI CapEx as a metric of what people might want to do if they did not have the ability to have liquidity in a market where you can enter and exit the position quickly.
Yeah, and look, China, especially China venture capital, China private equity was the flavor du jour, or the flavor of the decade for 10 years. Now, I think a lot of U.S. institutions are finding themselves in a very uncomfortable position now, and these private equity funds and these venture capital funds, there's a robust secondary market for those. And some of these funds are trading at 40, 50, 60, maybe even one at a 70% discount to stated NAV. People just want out.
So let's talk a little bit here about some things that you touched on earlier and that you brought into the China discussion. Debt here in the United States, and also your view about what Secretary Yellen and Chair Powell are doing at the moment in terms of their view of the macroeconomic outlook for the United States, the yield curve, inflation, and growth.
Right. So if we look at market signals, what is gold telling us here? We've been very constructive on gold for a long time. You mentioned my good friend and neighbor in the Bahamas, Kirill Sokolov, who again has been an incredible mentor to me in terms of how to think about really the long-term tectonic shifts in the world. And then, incredible thing about Stan Druckenmiller is he thinks about tectonic shifts and ticks. So I'd say and
what's the difference?
Well, Carol would say we are going from A to B in gold, and I don't really care what happens in between. We're on a rocket ride, and it's going to oscillate. Stan really knows when to size it up. Is like a big tell recently for gold was real rates started going up in the US, nominal rates started going up, which is normally, even in an uptrend for gold, is a signal that you're going to get a 5, 10, could be 15% pullback. Instead, gold went up 15%. So that tells you that there is some kind of an accumulation going on, whether it's foreign central banks, Chinese keep buying, the members of the Shanghai Cooperation Organization, what we call the Global South, seem to be buying, and U.S. consumers are buying. So I'm a big believer in the Vox Populi, and Costco is selling $100 to $200 million of gold a month in these tiny little bars. So you've got the second biggest central bank in the world, PBOC, buying, and you've got moms and pops going into Costco and buying. So there is some kind of a big change here, and I think a lot of it is holders of assets understand that we are reaching some key square, name of my firm, denotes the final move in the chess match when there's only kings and pawns left, and there's one square you can go to, and the game's over. And I think we are getting close to the point in this combination of monetary and fiscal policy where the game is almost over. And the markets don't want to finance this. And from our point of view, we have to figure out what the release valve will be. My guess is that it's going to eventually be the dollar. It could initially be rates, and gold versus the dollar done very well. It's outperformed the S&P since gold's outperformed the S&P since 2000. If you take out dividends, which is cheating, but if you take out dividends, the price appreciation of gold in the S&P since 1967 are the same. But Ash, to answer your question, I think the markets have now realized the precarious state of the largest economy in the world. We are running a 7% budget deficit with no financial crisis, no recession, and no war. This has never happened before. And it's inexplicable to me why we're doing it. Well, it's not inexplicable. Is Yellen is trying to goose the economy. She's a political appointee. And, I would say she has gone from public servant to apparatchik. And she is playing a lot of games. And she has shortened the debt maturity. So not only do we have these gigantic deficits, what is exactly the wrong thing to do is to move the maturities to the short end. So now that the US is becoming like an emerging market, we are rolling 90-day Treasury bills. And this goes back to, I believe that she and Powell thought that they would be cutting rates now. And obviously, this was a terrible miscalculation. The Fed failed the American people with the great inflation of 21 and 22. They were very late getting to hiking rates, and kind of in the ultimate absurdity is they were doing QE right up until the month before the first rate hike. So, but anyway, that was a long way of saying I think the markets, we're seeing this back up in yields. We've seen gold move up versus the dollar, and we are in a very unstable position now, because that for this year, just the interest on the U.S. debt will be $1.1 trillion. To put that into perspective, the defense budget is about $900 billion. So we are going into probably the hottest geopolitical situation, whether it's Russia, Ukraine, China, Middle East, Venezuela, since the Cold War. And we are spending more on interest than we are on defense. Mechanically, because so much debt is at the front end and the maturities have been brought in, mechanically, if interest rates are not cut this year, the US will spend $1.6 trillion on interest. So, it is something's going to have to give here. And, the other thing too was in the fall, Yellen, through the quarterly refunding announcement, announced that there was going to be fewer coupon bonds issued and more bills issued, which again goosed the market, loosened financial conditions, and then Jerome Powell at the November and the December press conferences, the actual FOMC statement was quite anodyne, and then he felt the need to loosen financial conditions and say that we were on course for a rate cut. So you ended up with this massive easing of financial conditions that sent the stock market up 25%, the tightened high yield spreads, and it has, I think, reignited the economy, especially on the higher end consumer side.
You talked about this idea of release valve, all of these macro frameworks that you lay out, the change in the internal debt dynamics of Treasury, some of the things that are happening in monetary policy. Of course, one of the challenges is finding the mechanism to express that in a trade. As you said earlier, talking about what the negative carry on a trade is. What do you think at Key Square Group about getting your head around how you actually implement the thesis in a way that the carry is manageable and that has that asymmetric payoff potential that you discussed?
Yeah, so I'm friendly with the who I think is the greatest basketball coach and general manager of all times, Pat Riley, and he has this great saying: "Keep the main thing the main thing." So we always try to focus. What is the trade? Where is the fulcrum? And we try to keep it very simple. It was during the Abenomics trade, it was just we're going to have a gigantic short position in the yen, and stocks are probably going to go up too. and I don't really need to mess around in the JGB market because I don't know what the JGB market could do.
Your Japanese government bonds.
Japanese government bonds. So it was just two things, seemed quite boring. And I like boring. I'm boring. For my portfolio to be boring, I like to do easy things. I remember a couple of derivatives people came in, and George Soros was in the meeting, and someone's like, "Well, I've done this, and I've got a swaption here and that," and George would look at him and say, "Does that mean you think it's going up or down?" So, one of my former partners used to be able to keep his ran a gigantic leverage book and used to be able to keep his whole portfolio on an index card. I've got 800% of this, a couple 100% of that, and that's life. And look, the negative of that is you don't always get it right. We've been very right on our analysis of the underlying Japan. We have been wrong this year. I thought it would result in yen strength rather than yen weakness, and we had a position.
We can pull up the chart of the yen just so because I want to show folks that this has been a pretty extraordinary period. If we could look at first the 5-year chart of the yen and then the 1-year chart, what you're seeing there is dollar strength, yen weakness, these unprecedented levels on the yen. What do you make of this? How do you explain it?
Yeah, well, I think it's a combination. And to go back, we own Japanese equities, and that should have just been our pure play. Is that Japan's reflating? There was a 10-year lag or 8-9-year lag in corporate governance, and the Nikkei is going to go to a new high.
Let me just contextualize this for folks who may not be following the Japanese stock market. One of the things that's been true the entire time I've been following financial markets is the Nikkei 225 hit a high in 1989 that it hadn't taken out for decades. That high has been taken out, trading now on the Nikkei 225, 38,405 on my screen right now. But just a huge multi-decade high swing. If you were long this position, you did extremely well.
Yeah, and look, I remember in 2011, one of our consultants called me and said, there's this guy named Abe. He used to be the prime minister. He's going to run for prime minister again. He wants to bring Japan out of deflation. And again, it was back to, well, that could never happen. They have declining population. They got a lot of debt, and well, voila, 10 years on, here we are. And there's been an incredible sea change. But Ash, back to your point on Japanese yen, that is a scary chart. I would say it's 40% undervalued, but as you know, in currencies, valuation never matters. I have been surprised that the Japanese government has been willing to let it go this far. They intervened. They intervened 2 nights ago in the currency when it went through 160. I think that the weakness of the Japanese yen, I would expect that Prime Minister Kishida will no longer be in office in about 2 months. And thus far, when I think about our kind of mental models or our signposts, we rely on people doing rational things, and his popularity just continues to sink as the yen continues to sink. Like if you were to overlay Kishida, the popularity with the yen, they're pretty tied together. But he's chosen not to do anything. I am not a believer that the yen is going to spiral out of control, because I would say that our divergent view here is that interest rate hikes are actually stimulative to Japan. So huge amount of personal savings, large corporate savings. It's really a very interesting setup that if the Bank of Japan would get into a hiking cycle, I actually think that they will stimulate the economy. So I don't think that they have to fall prey to fiscal dominance, and fiscal dominance is just the government is unable to raise rates because the size of the debt is so large, which we're flirting with here in the U.S.
Yeah, I was going to say, it sounds like in your thesis we hear echoes of that here in the United States.
Yeah, well, look in the United States, if I were to show a chart of how do we fund our debt, it's like the debt's doing this, and it's being funded from overseas. So we've got to rely on the kindness of strangers. The Japanese could always bring a lot of money home.
I know I'm jumping around here a little bit. There's just so many things I want to talk to you about. Uh, I could talk to you for hours, but I wanted to just talk about something. You mentioned your neighbor, Kirill Sokolov, in the Bahamas, perhaps one of your more less illustrious neighbors, as folks can see over my shoulder there, the Sam Bankman-Fried book that I co-wrote with Arthur Osinski and Elizabeth Bachman. You and I had a short call yesterday where we talked a little bit about something that I'd never heard spoken about anywhere else before. Talk to us a little bit about your interactions with Sam Bankman-Fried.
Yeah, and look, I know what my bias is against this creep. I've been fortunate enough to be part of an American family, but we've been multi-generational guests in the Bahamas, the 4 generations, and I love the people of the Bahamas. After the U.S., my favorite country, and the the people of the Bahamas through this crypto initiative were really trying to create a better future for themselves and for their children and for their nation. And Sam Bankman-Fried tried to ruin that. And there was a meeting with him with probably the 7 highest ranking officials in the Bahamian government, a lot of off island investors. And it was clear to me after 10 minutes that I wasn't buying what he was selling. As an adjunct professor in financial history, whether it was Charles Ponzi or Bernie Madoff, this guy was sending alarm bells off in my head, and I was shocked that other investors didn't question what this guy was saying.
Scott, how did you know so quickly when so many of Silicon Valley's elite venture capitalists were not able to see it coming? Was it something about his demeanor? Was it the way he was speaking? Was there something about the way he engaged that just immediately set off those bells?
Yeah, it was. He immediately, without a line of questioning, he immediately went to saying that he could hold all the customer. So this is February of 21, 22, but that this was in January, February, before FTX blew up in the fall.
Right.
And
Okay.
he just struck me as highly, highly agitated. And
Agitated personally.
personally agitated. And he was, without prompting, he felt compelled to tell the room that he had invented a new model, and that the old model, the old custodial model, was wrong. And look, the custodial model exists for fail safes and to prevent fraudsters like him. And he started. He was doing a trade on Robinhood, the app, while he's talking to investors and government officials, and dropping f bombs kind of every 30 seconds. And is that this effing app Robinhood? I've got to go through 5 other effing companies, and I don't need to effing do this. And I can hold the customer funds. I can be the exchange. I can be my own risk engine. I can do my own risk management. And it was one of those, well, Sam, nobody asked you. And then, I kind of stopped the tirade at a point. Sam, can I ask you 4 questions? I asked him 4 questions about how he's doing business. He told me that I didn't
What
know
were the questions?
Sorry.
What were the
It,
questions?
it was just, it was about how robust was the system? What would he do if there was a run on his bank? And he basically told me, I don't know what the F you're talking about. I don't think you know what the F you're talking about. I know what the F I'm talking about. I teach a course in it at Yale. You look like a U.S. bank in 1907 without a lender of last resort, buddy. And let's see what happens. Then tried to pivot the conversation to something more productive and ask him, you have the 7 most important people in the Bahamas here. What can they do for you? And his answer was, they can effing legalize Uber. We're having trouble getting home at night. I mean, it just like off the rails. But Ash, to your point, is we always try to be skeptical. I think that the more credentialed someone is, the more you have to examine them. That I went to Yale, and I don't believe in credentials. On a podcast in October, I actually came out and said I would never hire a Harvard undergraduate again. I think it is a failed credential. So, but back to your point, how did all these people fall for it? I think it was the high status of his parents. If you were to look at the investment memos, they were saying, oh, his parents are Stanford law professors. It's this, it's that. Whereas if his father had been a truck driver from Ohio, he wouldn't have gotten the same path. I think it's shocking that Michael Lewis, who really made his career or started his career lampooning the excesses of Wall Street and liar's poker, completely fell hook, line, and sinker for what Sam Bankman-Fried was selling. And, look, I think it's Michael Lewis probably needs to leave Berkeley, California, go back to New Orleans for a little while and get in touch with the street, not the Berkeley PhD program.
Well, it's just an extraordinary story about Sam Bankman-Fried, one I'd never heard before, and I literally co-wrote a book about him.
Yeah, and look, as I told you yesterday, I think it would have been very, very amusing if Michael Lewis's kind of slathering praise had come out and then FTX had collapsed. Again, for whatever reason, Michael Lewis is going down with the ship even after the guilty verdict. And one thing I will add on this verdict, and I've been in the press saying, I think he should get a long sentence. When people said it was a victimless crime, it's not a victimless crime. 400,000 people in the Bahamas suffered, the investors suffered, and the investors deserve what they got. Right? The people who did business with FTX, they've obviously lost out on these crypto gains. And look, what I haven't done a lot in crypto, much to my chagrin. My 14-year-old seems to make 10 times as money every 3 months, trying to figure out how a 14-year-old without a passport has a Binance account. But if you were to get away from the investment business and just into kind of societal things, I'm very worried about what this generation has seen of capitalism. Has seen a series of market failures, and what they construe as capitalism really isn't capitalism. They're seeing the worst of crony capitalism. They're seeing like government interventions. They're seeing right now, like the Green New Deal is crowding young people out of the housing market because this government spending is keeping rates high. So I do think that one of the great things about crypto is it's getting young people involved in markets, and it is restoring their faith that there is a way to make money, that that they've uh, been willing to embrace the new thing, and that many older people haven't. So, people say to me, "Well, crypto doesn't have any value; it doesn't have this." And look, I can tell you that when people agree on a means of exchange, it has value. Is a friend of mine's grandmother in 1998, the Russian economy collapsed, and they went into this hyperinflation. She went out and bought 18 bicycles and kept them in her apartment and sold them off because bicycles were her inflation hedge. So, you never know what the inflation hedge is going to be. But, I'll put in the plug for gold again. I just keep coming back to kind of big and small agree that that is the hedge.
It's interesting. You said something in a sort of very casual way where you said if Sam Bankman-Fried's if his father had been a truck driver, he probably wouldn't have gotten a pass. Scott, there's something about that I think Americans right now at this moment in history feel so viscerally. You can see that anger and frustration on the left and the right. Perhaps the one thing that folks across the spectrum agree upon that the system certainly seems to be unfair.
Uh, yeah, look, I'm very, very concerned about that. I gave a talk the other day, and I said we are failing the bottom 50% of our yeah, of our wage earners. Because if you think about it right now in the U.S., there's us. There are two kinds of people. There's us, and you either own assets or you have debt. And and look, it's easy to snipe at the Fed. It's easy to snipe at Jerome Powell. But I do think that there is a colossal failure here that is exacerbating what's happened, because by the goosing asset prices, which is what he did when he eased financial conditions, it's making the top 20% better off. And we know that I think the top 20% accounts for 40% of consumption, and then the bottom 50%, they have debt. They you're starting to see. There's an article in the American Banker last week that credit card delinquencies are now the highest that they've been. The Philadelphia Fed measures this. Credit card delinquencies are the highest that they've been since they've been started measuring them in 2012. So Nancy Lazar at Cornerstone Macro wrote a great piece called "The Bifurcated Economy," and that's really what you've got. You either have assets or you have debt, and I can tell you that it bothers me that this bottom percent is they 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 have a voice, and they're going to have their time at the ballot box. And if I could imagine in 2028 that the candidates are AOC and JD Vance, and they are to your notion on this left right agreeing, they are both quite populist, and nobody on Wall Street is going to like what they have to say. Is like, I'm not sure whether I agree with him or not, but Senator Vance wants to get rid of stock buybacks. Uh, we know what AOC wants.
Scott, for a young man or young woman who might be listening to this conversation today and hearing maybe some of the things that they feel emotionally explained to you in a very clear narrative based on quantitative analysis, what would you say to them? What advice would you have for them? What mental models have you used in your life that have enabled you to experience the kind of success that you've had that they might be able to implement in their own?
Yeah, well, one is you got to be willing to take a risk. Is I always tell everyone, I've said in a couple of other interviews, it seemed terrible at the time, and it was, but during my childhood, my dad went bankrupt twice. I think once when I was 7, once when I was 17. So the status quo was not something that I could stick with. It was for me. I was willing to take a risk, and I almost we've been quite we've been quite prosperous before he decided to leverage up. So I kind of wanted that lifestyle back, but I was also, I didn't think I had to go a conventional way. I didn't want to do a 2-year banking program. I didn't want to go into a bank training program. So as Ash, as you teased out at the beginning of the interview, I saw this thing called hedge funds, and it was this idea. No one used to take 15 or 20% of the profits, and I thought, boy, that's a good idea. That's better than working in a trust company for a 1% management fee. So I would say, one, be willing to take risk, and think how much risk are you willing to take. 2, what is changing? Like, where can you get yourself in front of the big trend? Like I often think I got in front of the big hedge fund trend. I've been successful. I probably should have been a lot more successful given how I identified that trend. But what are the mega trends here? I spoke at a university the other day, and I said, if I were 28, I might go to Japan. Could be very interesting. I would say a big mega trend. I don't know where all this AI is going to go, but I do know is people are going to have a lot more free time. So what can you do? Is it gaming? Is it, what kind of leisure activities can you get in front of? I mean, look at the multiples on these professional sports teams. So what can you do to kind of satisfy if people are going to have more downtime? Are they going to want to travel more? Are they? So the real advice is be willing to take a risk, know how much risk you're willing to take. Don't get tied down with too many fixed obligations, and try to get in front of a big trend. You can make I made a ton of mistakes in my career. If you're in a big trend, the big trend covers up a lot of the mistakes.
Scott, truly extraordinary conversation right here on Real Vision. I hope you'll come back and do this with us again soon.
Good. I'd love to, Ash. This is a great forum. Thanks.
Thank you so much for joining us. And thank you for watching. Thank you for listening.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.